Hello, my fellow investors, and welcome to, oh boy, the beginning of quite possibly one of the biggest weeks when it comes to earnings for the quarter. And we are going to start off with analyzing, guys, the company Schwab. Now, they did have earnings today on Monday. Now, Monday, there really isn't that much of anything that I really want to take a look at. Things start to pick up tomorrow, Tuesday. So when you guys are seeing this, we got Bank of America, Netflix, Johnson & Johnson, Goldman Sachs, oh dear Lord, Prologis. Then Wednesday, oh boy, Tesla. That's going to be fun to do. It's always fun to do. TSM on Thursday, you got American Express, Rite Aid, AT&T, Procter & Gamble on Friday. It's just going to be absolutely crazy. But for now, guys, let's actually take a look at Schwab and take a look at their earnings. Take a look at what the discounted free cash flow actually says. Because, well, Schwab is the one platform that I use to invest. So let's see if maybe they may be a good company to put money into as an investment, not just a platform for investing. So with that said, let's get started with this analysis. Now, taking a look, guys, at the earnings, well, unfortunately, it is not updated yet. Now, EPS normalized estimate came in at 90 cents, EPS gap estimate 81 cents, revenue estimate of $5.13 billion, and you can see there was a lot of just downside revisions. But what actually happened was the fact that Schwab actually beat non-GAAP EPS of 93 cents, beat by 3 cents, revenue of $5.12 billion, which unfortunately missed by $10 million. So they missed, and at the same time they did beat, but the beat was just barely nothing. So that's unfortunate to say the least. We got over here Schwab press release, of non-GAAP EPS of 93 cents, beat by 3 cents, revenue of $5.12 billion, which is actually an increase of 9.6% year over year, missed by $10 million. Shares were up 1.1%. Very, very interesting to say the least. So yeah, this is one instance that unfortunately it was 50-50 when it came to their earnings. So let's get started, guys, with the press release. Now, like always, please remember this is not financial advice. Every investment is the present value of all future cash flow, and I will have this earnings report linked in the description below. I forgot to do it for yesterday. I'm so terribly sorry, but I will remember to do it today. Nonetheless, though, let's get started with these earnings. We got over here Schwab reported strong first quarter results. Okay, client business momentum continued. Organic asset growth exceeded 7%, 10% year over year revenue growth. GAAP pre-tax profit of 41.2%, 45.8% adjusted. Interesting. The Charles Schwab Corporation announced today that its net income for the first quarter of 2023 was $1.6 billion, up 14% from $1.4 billion for the first quarter of 2022. Very, very interesting to say the least. And actually, we get over here. The net revenues, this is in millions, was $5.1 billion, as we just saw, because as opposed to $4.7 billion, right, in 2022, and we can see that is an increase of 10%. And taking a look at the net income gap, we got 1.6 billion compared to 1.4. That is an increase of 14%. The adjusted one, 1.78 compared to 1.6, increase of 12% again. This is beating, guys, their last year's like by a pretty good amount. That's actually good to see. Not gonna lie, that's really, really good to see. Diluted earnings per common share, we can see 67 cents compared to 83 cents. That is an increase of, once again, 24%. And then adjusted 77 cents and 93 cents, increase of 21%. So let's actually come now into the CEO's comments. Now, I am not going to read the first one. I would actually like to read the second paragraph. We get over here, quote, the first quarter presented clients with mixed macroeconomic backdrop. Mr. Bettinger noted, while equity markets rebounded from year-end 2022 levels, investor sentiment remained bearish, especially following the onset of the banking industry turmoil in early March. Fixed income markets also reflected growing fears of an economic downturn as the 10-year U.S. Treasury yield declined approximately 50 basis points from its intra-quarter peak to end March under 3.5%. Through the various ups and downs to start the year, Schwab remained a trusted partner to investors. I personally like Charles Schwab a lot. During the quarter, clients opened up over, 1 million new brokerage accounts and entrusted us with $132 billion of core net new assets, including over $53 billion in March alone. While investor services gathered approximately $60 billion during the period, the advisor services segment posted a record quarter of over $71 billion in net flows and attracted 70 transitions advisor teams. These near record inflows across both our primary businesses represent an annualized organic growth rate of north 7% and helped us push total client assets to $7.58 trillion at quarter end. Guys, I believe I'm pretty certain that this $7.58 trillion is actually their AUM, their assets under management. So that's actually really, really solid to see. Not gonna lie, $7.58 trillion. Very, very nice. Now, what I'm interested is their competition. So I just decided to look up, guys, Fidelity's assets under management. We can see that it's $4.5 trillion. So Schwab right there is doing a lot better. Granted, I don't think that this is from as of this quarter. Unfortunately, I think it might be a little bit higher, but I don't think it gets to that $7.58 trillion. In fact, looking at Vanguard, we could see that, well, as of, I don't know when this was taken, but according to Google, we can see that it is 7.2 trillion. So even then, it's slightly just higher than what Schwab was back in like 2022. In fact, if we take a look at this, as of August 2022, Schwab's assets under management was 7.13 trillion. Now, obviously, the earnings report says the brand new one, which explains why it's a little bit higher. Nonetheless, though, we can see that Schwab is still doing very, very good when it comes to their AUM. So if we can actually come down here, guys, to page 4, it's just a table of what we just saw there. You guys can take a look at this for yourselves. Nonetheless, though, it's still fairly interesting to say the least. Now, with that said, with the discounted free cash flow, we got the ticker symbol for SCHW. And we got the market cap for $93.3 billion and a PE of 15.06 with the current share price of $52.77. Now, man, after the whole Silicon Valley thing happened, guys, Schwab took a nosedive. Like, this was a big one that fell a really big amount, like when the whole Silicon Valley thing happened. So you guys can see that, like, right there. It was it was actually at 70. Look at this, guys. It was as high as $85.43 back in like January of this year. And then after Silicon Valley, it went from 76 all the way down to the current share price, as you guys saw, around $50. On the 1 year, they're down 29.58%. Year to date, they're probably, wow, they're down 35.6%. 52-week range is $45 on the dot to $86.63. So not 52-week lows, and it's not near it, but it is definitely nearer, I guess you could say. It's more near than what you would usually see. So this may actually serve as a pretty good buy-in point right now, I'm not gonna lie. Now, coming back into this kind of free cash, we can see that they do pay out a dividend of $1 on the dot, and this is a yield of almost 2%, a payout ratio of 21.48%, 5-year CAGR a whopping. Guys, that 5-year CAGR is ridiculous. 21.22% with only one consecutive year of dividend payment. That's already putting up a red flag. So taking a look now at the history, if we take a look at this in the 5-year, we can see that, well, that's actually interesting. Why do they only have 1 year? Is it because from what it's looking like, they never increased it in 2020 and 2021. There you go. From 2020 to 2021, they never increased it. They just kept it the same at 18 cents. So it's not that they cut it, they just, probably because of COVID related things, they were like, nah, we know what, we'll keep it, but we're just not going to increase it. So that's a little bit more explainable. Though that 5-year CAGR is just, man, well, their cash flow isn't really that good though. Man, wait until I show everybody this. Ex-dividend date passed as of February 9th. Payout date was on February 24th, and they pay their dividends quarterly. And taking a look now based off of this dollar in annual dividends, as well as the current shares outstanding, they pay out almost $1.9 billion in dividends every single year. And in regards to the 5-year average free cash flow, after this is paid, they're still left with around $4 billion. Their last year's free cash flow, yeah, after this is paid, after this 1.85 to be exact billion dollars is paid in dividends, well, based off of the last year's free cash flow, they are in the negatives by negative $767.2 million. That's really bad. In fact, these payout ratios, guys, the last year's free cash flow, it is 170.64%. And the 5-year average free cash flow, for some reason, or at least the payout ratio, 32. So you might be thinking, okay, well, this may just be that one time. Maybe they just had an outlier where they just like crashed their free cash flow or whatever. Okay, so with that said, now let's actually jump into the graphs and see if that's actually the case. So let's start off, guys, with their fundamentals and the net income. We got 5 years ago of $3.51 billion to 1 year ago of $7.2 billion. That's a pretty good increase of 105%. We could see that from 5 to 4 increasing, then COVID hit, so this came down to $3.3 billion, but then they shot up massively 2 years ago from $3.3 billion to $5.85 billion, guys, and then another pretty big jump, around $2 billion from 5.85 to 7.2. So I do not like those spikes. I really, really don't. So it's still, you know what? I have this as a 75. I don't personally know. I'm actually half tempted to put this lower as like a 65 because again, it's just too big of a jump from like even 4 years ago to 2 years ago. It's just too big of a jump for me. So I'm gonna go with a 65%. Looking now at the free cash flow. Yeah. So we saw a little bit of this when we took a look at the dividends, right? And the payout ratios. Guys, their free cash flow is not good. Not good at all. This is consistently decreasing, and by a lot. We got 5 years ago of $11.88 billion to 1 year ago of, well, $1.1 billion. That's a decrease of 91%. That's not good. That's not good. Average, it is $5.8 billion. Guys, I mean, 5 to 4 to 3, massive decline. And then from 3 to 2, it was just destructive. 6.2 to 1.2. That is a decrease of what, $5 billion? That's insane. And on top of that, this wasn't a case that, oh, you know, their capital expenditures just went up. No, no, no. So if we actually come over here, I'm going to show you guys their cash from operations. Take a look at this. Cash from operations, 12.45 billion, then 9.3, then 6.8, then 2.12, then 2. Even though their capital expenditures, they have gone up, but I mean, it's not compared to this drop from cash from operations. So this is a problem, because if the cash from operations is going down, you know, you could make the case of like, okay, well, the capital expenditures is going up. Okay, so at least reinvesting back into the company. No, this is a case where their cash from operations is coming down, which is even worse. So I have to give this a 0. Now, with this being a 0, guys, this is probably going to bring down the grade a significant amount. So let's see what the other metrics show. We got the revenue up next. Very, very similar to that of the net income. However, we can see that it is, well, there was no decrease 3 years ago. We got $10.13 billion 5 years ago to 1 year ago of $20.76 billion, increase of almost 105%. Now, I gave this an 80% mainly because this is actually a pretty good increase from 5 to 3 years ago, but the spike kills me. The spike from 3 to 2 years ago kills me, even though they were able to replicate that from 2 to 1 year ago and increase it by $2 billion or so. Nonetheless, though, I don't like the spikes, but there is no negatives, I guess you could, sorry, there is no decreasing it. So I'm going to give this an 80%. Reluctantly, but 80%. Now, taking a look at the assets minus the liabilities, this one is just bad. I mean, it could be worse. I guess you could say that there could be negatives, but you could see that a massive spike happened from 4 to 3, and then a slight increase from 3 to 2, and then a crash from 2 to 1. You know, going from $21.7 billion to $56.1 billion, and then to $56.26 billion, and then from $56.26 to $36.6. That's a lot, guys. That's a lot. So I don't like, again, massive spikes, massive drops. It's just, I don't like it. Average total assets is $522.76 billion. Average liabilities, it is $481.31 billion. Doing this difference, we get $41.46 billion. Guys, I'm giving this a 60%. I'm actually half tempted to give this, no, I think a 60% would be pretty good because there are no negatives. The spikes are there, but there are no negatives. So it's, yeah, I'm going to give this a 60%. Maybe you could make the case for 50, 55, but I'm going to go with 60%. Now looking at the cash flow minus the liabilities. We know that their cash flow is completely crashing down. Yet even with that, you still see 2 years over here from 5 to 4, where it slightly increased by around $300 million. And then after that, it just collapsed 3 and 2 years ago. But then as of 1 year ago, they've actually brought it up. So, you know, they went from what, negative $609.8 billion to negative $514.1 billion. It's an increase. Not a good one, but still an increase. Nonetheless, though, this is still significantly lower than the average of $427.64 billion. I'm going to give this guys a 20%. Looking now at the shares outstanding. Unfortunately, this one, it is no good. And, well, I still have the same grade as before. But nonetheless, though, we got 5 years ago of 1.33 billion shares to today, guys, of 1.85 billion shares. That is an increase on the 5-year of 39.1%. And from the previous year to the current year, this is a small decrease of 2.11%. You can see that the majority of the spike happened as of COVID. So they went from 1.285 billion shares to 1.88 billion shares. And they increased it a little bit more from 3 to 2, but as of 2 years ago, they've started to buy it. Well, they've only bought it back 1 year, so yeah, it is what it is. Overall, though, I don't know if they'll be able to continue this. So I am going to give this as like a 50%, mainly because this could go 50-50. They've had instances where they have bought back shares, and COVID was a special case that they spiked it. And I guess you could say, 2021 was also a pretty good special case, so they upped it again. But as of then, you can see that they are buying it back just like they were from 5 to 4 years ago. So this could go in any direction. I'm going to give this a 50%. And lastly, looking at the cash equivalents, they currently hold $40.2 billion with an average of $40.2 billion. When it comes to the overall grade, guys, I mean, with a 0 in free cash flow, it's not going to be a good grade. Net income, we give 65%. Free cash flow, 0%. Revenue, 80%. Assets minus liabilities, 60%. Cash flow minus liabilities, 20%. Shares outstanding at 50%. Overall grade of 45%. I was very disappointed when I saw this, especially that free cash flow. That's the main problem. If they were to fix the free cash flow, the cash flow minus liabilities will also get fixed. It is what it is, unfortunately, but 45%. This isn't a passing grade. Now, they have fallen as of recently, a lot. So let's actually see if the current share price is looking like a buy after the massive drop. So let's come now into the discounted free cash flow. And, well, not inputting any numbers, guys, just having the required rate of return 10%. We got over here target share prices, not adjusting for debt, of $15.65. And this is hilarious because adjusting for debt, well, $52.99, and the current share price is $52.77. I love it because, well, it fell from a peak of, once again, $86.63. The fact that it fell to exactly, or pretty much near exactly, where my target share price is after debt is, not adjusting for debt with no assumptions made, I don't know if that gives me credibility or not, but I'm going to take the W on that one. So let's put in some numbers. Now, remember that in regards to their earnings report, if we can actually come back over here, we can see that their revenue has increased 10% over the past year. So I'm going to use the same logic I used with yesterday's, I believe, UNH. And I'm going to set this 10% as the highest revenue assumption. So let's say 10% for that one. For the median, though, let's come over here to Seeking Alpha and see that the forward is estimated at 7.35. So let's use this as some kind of metric over here. So let's say 7%, and let's decrease this by another 3% to, let's say, 4%. Now for the projected share buyback, guys, they have been issuing a lot, but the issued only happened technically 1 year, right? They only issued shares just technically 2 years, right? Let's say that they do buy back. Let's say that they do manage to buy shares back at a pretty reasonable, really small amount. So let's say 1%, 2%, and 3%. Okay, so with this, in the required rate of return 10%, we got the target share prices, not adjusting for debt, $18.21 to $22.78. And then adjusting for debt, we got $58.33 to $67.93. With a margin of safety of 5, 10, 50%. This puts me between $49.58 to $64.54, assuming the lowest assumption to the highest assumption. Guys, the current share price is $52.77. So you have a lot of margins here that this actually falls under, believe it or not. I mean, guys, you got prices like, for example, $55.41 over here. Even the $42.49, honestly, for the lowest assumption, the 10% margin of safety, that's not too far off from the current share price. So there are a lot of points here that might tell you, hey, this is looking like a pretty good buy today. But again, their fundamentals just aren't there. Again, with a grade of 45%, it just isn't that good for me, even though the share price is looking fairly decent. The main problem, again, is their free cash flow. Now, just because it's my opinion, that doesn't mean that you need to follow it. This is why every assumption that I have made here, guys, you could make yourself, because I gave out all of these calculators available for free. The link is in the description below. There's not financial advice, so please use these calculators. Every single one that you see in the videos. You got the re-evaluation calculator, which I rarely use. There aren't that many REITs. This is kind of free cash flow, and the book value, and even the dividend tracking sheet for everybody to have. all we're asking for in return, guys, for daily content, the monthly live stream, and all this crazy stuff, and even new projects as well, is just like, subscribe, comment. It really does help her with the algorithm on YouTube. Thank you so much for everybody who have done that so far. I'm gonna shout out, guys, the commenter. You know, thank you so much for this. Please, you know, I'm not asking for you guys to do this, but man, when you guys do this, it really does hit my heartstrings like a lot. I'm gonna shout out, guys, another name where he donated $5 on the Citigroup stock analysis that I did. He pretty much just said, I'm gonna highlight your comment. Love your effort. You know what? I love your comment. So thank you so much for the support. Please do not feel obligated to give me money. I really do appreciate it. But you know, if you can't, you can't. I'm not asking for you guys to, you know, I'm not gonna do that, right? I give out everything for free because I want everybody to make their own financial choices. But thank you so much for the donation. I really, really do appreciate it. We really do appreciate it. Mike and I, we really do appreciate it. So thank you. And here's your shout out because, you know, I'm a small channel. We're a small channel here. I never thought that I would have anybody ever give me, you know, $5. Give me any kind of money. I would just be happy with like $1, honestly. But thank you so much. I really do appreciate it. So yeah, guys, the best way that you guys can help us is nonetheless, like, subscribe, comment. Really does help here with the algorithm on YouTube, and of course, word of mouth, share, help us grow the channel so that way I can keep making more and more content and more projects for you guys to watch. So now let's move into the dividends. With a $1 dividend and around 2%, not gonna be that big though. Putting in $5,725, this nets you $108.49 in annual dividends. Yeah, it's not a lot, and on top of that, the weighted grades just isn't enough for me. So it's pretty lackluster in my personal opinion. And lastly, let's take a look at the options chains. Not surprising, guys, they have weekly options, okay? And, well, April 21st, their puts are looking okay. You know, it's expiring on Friday, so we wouldn't expect this thing to be that high. When it comes to the calls, also on April 21st, they're actually better than the puts. So this may be one that if you do have 100 shares of and you don't mind losing the shares, you might want to sell this at around like a strike, anything higher than what you bought it at. So, you know, these are the options chains for April 21st, 2023. All in all, this is the earnings report as well as a small stock analysis for the Schwab Corporation. I gotta say, I'm actually not that happy with the numbers I saw, especially the free cash flow. Yeah, that's all. I'm gonna leave it at that. Nonetheless, though, tell me what you guys think in the comment section below. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the Tech sites. Link is in the description below. So with that said, peace out, and we'll see you all in the next earnings report video, which, I mean, you guys are gonna get a lot this week. So be on the lookout for that.